Good morning. You're watching the market right here on 80 Now. Finally Friday, and the global markets seem a lot more settled than yesterday now that the Fed meet is behind us and the takeaways are well getting absorbed. And so is the commentary actually. While it's not a runaway move by any global markets this morning, the SGX Nifty once again is only indicating at best a very, very tempered move for us. But yes, I guess, the big question is what happens next for global markets before us now that the event risk is over and volatility is sustainable.
Yeah, that's quite amazing. The general view was, okay, this is the event, you come on the right side of the event, market's going to spike up. You come on the wrong side of the event, market's going to crack down. You've come pretty much on the right side of the event in terms of the positioning. So markets have not rallied, but volatility has gone up, which means that markets are confused or they are nervous. The buyer and the sellers are not really able to fathom that what the near-term price action would be. In terms of the sequence of the event, I think it's very clear what Fed is communicating, which way interest rates are moving, the impact of US economy on hike of interest rate hike. All that put together, you know that you are in for a patch of lot of government action, but eventually towards the second half of this year, interest rates will peak out, demand will come down, and things will be significantly lower, at least on the demand front. So that's the template markets are aware of, but I'm surprised that this kind of a template is not leading to any convincing price action. And when you see a 2-3% swing on a daily basis in an index like S&P or Nasdaq, it just tells you that the market sentiment is fragile, and there is a commitment phobia. Let's use that new word. There is a commitment phobia. And that commitment phobia, I think, is clearly evident, at least on Wall Street.
Yeah. Pretty much it is, considering, at one point in time, the Dow pretty much soon after opening was holding up about 500 points, and then it finally settled just about with a whimper in the green, about 75 odd points or so. Similar has been the price action for both the S&P. Nasdaq, though, was a little bit better. Having said that, US Treasury Secretary Janet Yellen has spoken overnight, and she's highlighted much of the same from the commentary that she gave on Wednesday. One small addition, though, stating that certainly we should be prepared to take additional actions if warranted. She reassured that strong actions are to be taken to ensure deposits are safe. This is her commentary highlighting the banking crisis currently prevalent in the US. But having said that, I guess volatility stays and nothing different for us also, Aman.
Absolutely. Yes, you had, as you just flagged off, that the Wall Street did manage to end in the green, but you have the Asian markets, which are anything but. In fact, it's a sea of red across the board. That's the SGX Nifty as well, indicating that it could be a softish start. That's the dollar index as well, trading sub those 103 levels. But back home, what did we have in terms of cues from the Lal Street? Well, the Nifty, it closed just about 125 points off the day's high. We snapped that two-day gaining streak. Yet again, you have FIIs, which remain net sellers, nearly 1,000 crore rupees. And it was the banks that bore the brunt of it. In the second half of the trading session, a lot of those banks did come under pressure. And Nikunj, you did have the Nifty premium as well, which has fallen currently at about 9.
Yeah, and it's again that commitment phobia I think is there, and I think it's evident on a day when market should have rallied more like a relief rally post the Fed meeting. What did we see? A good start and then a slow grind. That's pretty much been the pattern. That global strength is something which is not really giving Indian bulls a spring in the stride. The fact that premium is down, rollover is low, FI positioning is short, it just it just tells you that while market may be focusing a lot in terms of the near-term events, but the desire to trade long, the desire to participate, the commitment to create long positions, the drop in volumes, all of them are just pointing to the fact that the market is in a slow grind move. I don't think the markets will see a crack or a meaningful downside. But you actually are experiencing supply at the upper level. I guess with each passing day, Aisha, the problems are getting very smartly arrested. The Adani fiasco, that's behind us. Globally, what will happen to banks, that's behind us. Now markets will adjust on 3 factors. Number 1, liquidity, which is anyone's guess what FIs will do. Second, the terminal value for a lot of companies will change because of the slowdown. And third, I guess you're also reaching that end of the market. A lot of stocks now trading below the long-term averages. That's where I think you'll have to say that the pot of the gold or the treasure hunting would be done. It's like saying you'll have to now find diamond in the rough. It's not like there is a universal wave of bull market. You'll have to find diamond in the rough. And trust me, if you do your hard work, sweat it out, there are a lot of diamonds in the rough now.
And just to add to that, the latest Hindenburg report was not on any Indian
Exactly,
corporate.
exactly.
What a relief, right?
So what impact they're having? I mean, imagine.
Yeah.
An unknown brokerage has become like the most scary name in the town if you are long.
I mean, it's the new Fed.
Exactly.
To call it that.
I mean, you'd say that, never fight the Fed in this case, that never ignore Hindenburg.
Yeah, absolutely.
But
I was just looking at Accenture numbers though, while what's made headlines is, of course, that 19,000 job cut. But just looking at the granular numbers, and they've had record bookings, the pipeline has been robust, and the commentary as well is pretty okay. I mean, justifying that 19,000 job cut, what they've said is that the job cuts are to optimize cost, not growth. There has been a marginal cut in the upper end of their guidance, but they see no major impact on large bank spends yet. The Q3 ask rate has come in at 3 to 7%. On a constant currency year-on-year growth basis. The Q4 ask rate at 5 to 9 odd %, which is pretty much in line with what the markets were anticipating. In fact, overnight, you did see Accenture jump up as well in trade, held higher by about almost 4 odd % the last time I checked. But yeah, is it really going to set the tone for IT back home, which has been in the doldrums in terms of a stock market performance?
These are not bad set of numbers.
Yeah.
Look, I mean, what they've done is they've said the obvious. And the obvious trend is that large deals are getting bigger, small deals are getting marginalized. The cost pressure on the client front would be there, so the cost moderation has started. And the fact that Accenture has put out this non-critical number of 19,000 layoffs, much bigger than what you've got from some of the US big tech for. It just tells you that IT companies are now getting very cost conscious. So for me, it's business, the business definition or the business background what Accenture has indicated, that's not new to the market. But what is new to the market is that what kind of cost pressure some of the IT companies actually would be doing, which means that they will be forced to squeeze out a lot of efficiency. What that means? That also means that the peak of attrition rates, which was a struggle in 2021 and 22 for most IT companies, that's also behind us. Now the stock went up yesterday because everybody was on the same side of the boat. If you want to use that as a benchmark, I guess the benchmark is that Accenture numbers have been a lead indicator, but not the most reliable indicator of IT companies, because TCS is on one path and Wipro is on the other path. But the tone what they've set is very clear, that business has not meaningfully contracted, cost pressures are real, attrition is going to be going down, and now it's about really squeezing out more efficiency, more, if I may use the English line, the more bang for the buck. I think that is what IT companies would be forced to do.
Okay, so that was the tone really coming in from Accenture and how one should really be digesting it. But meantime, let's also focus in on other news and updates, and seems like it could be a setback when it comes to debt schemes, as the LTCG benefits, this is for, will be over for gold, international equity as well as domestic equity FOFs, and a lot of key amendments as well, Nikunj, have been added to this.
Yeah, this is more like a bolt out of the blue, frankly, if you ask me, because it came as an amendment in the finance bill. Normally, it should have come on the budget. What that simply means is that if you look at India, in India, if you are a debt investor, you do get benefits of indexation, which means depending on the tax bracket you are in if you extend to a certain time horizon, you do get benefits. Those benefits are gone. HNI investors have used indexation to their advantage, and a lot of money which was parked, let's say, in a traditional instrument like fixed income or for that matter FD, was moving into debt largely because of this indexation benefit. If that goes away, it's going to be having an impact on mutual funds, and especially some of the debt schemes, and especially some of the HNI collections. Mutual funds as it is have been going through intense pressure because of competition, because of the way the cost structures have been coming higher, and how the commission ratios have been moving. The TR has been coming down. So this is going to be another cog in the wheel. I mean, as it is, we know that mutual AMC stocks in India are nowhere close to the kind of commanding premium they were having. So this is something which is more like a bolt out of the blue. But what it simply means is that it takes the disadvantage of a fixed deposit, and it purely means that the tax arbitrage what HNI investors I mean, not HN Invest, anybody was enjoying. If you're investing in the debt scheme with the advantage of indexation, that's now behind us. It's long-term positive, but in the near term, I expect the AMC stocks, and especially the schemes which get a lot of money from debt, they will go down. I mean, to put it very simply for our viewers, if you invested beyond a certain point, you are not paying tax. That was the way the structure was.
I
Now,
wonder if it's advantage equities or not, equity funds.
see, my logic is that somebody who's investing in debt fund is aware of the fact that equity is a volatile asset class. So when you're choosing equity, when you're choosing debt, the underlying thought is that you're
You wanna
choosing
be
a different
safe.
instrument.
Yeah.
This actually would be advantage FD
Yeah.
and disadvantage mutual fund, because in FD you now would be taxed as per your tax structure. FDs, in a sense, this also is good news for banks, because a lot of money was moving from FDs to index funds. You know, your wealth manager would call you and say, "Sir, ye karo." This is where the tax advantage is. And that is where I think money should come back to FDs. Long term, but nothing changes tomorrow morning. But long term, I think this trend could be at play.
Yeah, absolutely. Okay, let's welcome on board Rana B. Gupta as well, MD at Manulife Investment Management, to talk about what he's making of the various headlines right now. Rana, hi, good morning. Great to have you on the show. How is it that you're reading
Good
into
morning.
Fed's commentary and then, of course, Janet Yellen's as well last night?
Look, I think those comments they will take care of the market conditions, and with the way situation evolves, it is very volatile situation out there. But overall, if you take a slightly medium-term view, overall we think the risks of the contagions will be contained. There will be adequate policy support given that way. As a result of that, I think markets will continue volatile for the next month or so. But I think the situation overall should settle down, and we don't think that this will unfold into any sort of crisis. What it can mean, though, can happen is that the U.S. growth might moderate going into the second half of this year.
Rana, FIs are selling into India. Is that a compulsive factor because of redemptions, or this is a choice where China looks better than India? And do you think this trend is here to stay?
I think this trend has been there for some time. I think sometime from late last year. The few reasons, what at least we understand. See, Indian market has been a performer in 2020, 2021, and 2022. So there is some profit taking. Plus, there came China reopening. So therefore, some switch of assets from India to China we have seen. Right now, I think globally stock markets are in a bit of a volatile mode, so people are doing their adjustments. But I do not think the situation is permanent. I think ultimately the broader signs are getting clearer, which will of course take medium to long term to see effect play out. They are US dollar is peaking, then the rate peak is in sight, emerging market growth and emerging market balances are better. That overall sets a pretty positive construct for emerging markets. And within that, because of the reforms that happened in India over last 10 years or so, I think it looks pretty attractive. So I do not think this FI selling is a long-term thing.
So can I say that forget what others are doing, Manulife is not selling Indian stocks?
I won't be able to give insights into that, but I think we are longer term remain quite positive on equities.
What do you own in your long-term portfolio where you say, I don't care about Fed, I don't care about 2024 elections, I'm going to be a buyer because I think 3 years out these stocks will be bigger, or these companies will be bigger?
Yep. I think there is merit in that thought process, because again, if you look at a 3-year time frame and see what's going to happen, I think the digital economy is booming, and that is not just helping, let's say, our .com internet companies. I think this has been a game changer for the banking companies in terms of their, in terms of controlling their costs, and also various other companies to increase their productivity. And on the other hand, because of the physical infrastructure and the PLI schemes, all the tax cuts, I think manufacturing in India is growing. And this is further helped by the China Plus One, the multinational companies' desire to have alternative sourcing base. I think Indian manufacturers are seeing a lot of inquiries. So I think this stocks from the banking and the industrial side, they look pretty attractive in a 3-year perspective, from a bottom-up perspective as well.
Time to connect. All right. Thank you so much, then, Rana, for joining in, of course, and giving in your views. That's the take coming in on commentary from the Fed as well as the India portfolio. Time to now connect with our chartists. We've got Naresh Mirani as well as Kunal Bothra, as always, joining in. So, Kunal, let's get in a flavor as to what exactly a strategy is going to be for the day. We don't have a great handover from Asia, at least. You've got the index that wrapped up lower by about 0.5% across the board, and banks really bore the brunt of it. So, what does that make for today?
Well, good morning, Avan. So nothing changed in terms of the data, in terms of open interest yesterday. Yes, there was a dramatic kind of a selling which happened in the last half an hour, last 1.5 hour for the index yesterday, where the bank Nifty corrected more than 600 points, Nifty corrected more than 150 plus points. And I think majority of that is because of the unwinding of positions. Now, there was no major change in terms of the open interest. I think just 0.79% addition in terms of the Nifty OI and a 2% jump in the Nifty OI for the current month futures, and that indicates that this could not be a major shorting which has happened for the indices. So this again brings the near-term trend back into a range for the indices. So 16,800 as a major support, 17,200 as a resistance, and I think we've been languishing in this range for last 5-6 trading sessions. So I think till the time we don't see a breakout or a breakdown of this range, it's going to be a bit difficult to try and preempt which side the markets would trend into. So we'll expect that in this kind of a range bound, in this kind of a range, it's better to go with stock-specific trades rather than going with any kind of an index trades.
Naresh, stock-specific approach for you as well?
Yeah, that's been the approach because if you look at the markets, we've been at the same place for almost the last 10 to 12 sessions. We try to go above 17,000, do not sustain. We try to go below 16,800, becomes the support. So it become a 400-point range for the Nifty. And in that range, it's difficult to trade the index. So for now, it's a hold with a stop loss at 16,800 and a trigger point at 17,200. Once we start crossing that, that would be the first indication of a change in trend. So for now, we are right in the middle of the very small range.
Okay, so let's get stock specific. Naresh, what's on your list?
So continue to play defensive. First is a buy on NTPC. The stock has corrected from 180.82 to 174 levels. A risk reward trade here, a place to hide. A stop loss at 169 and a target price of 190. Second is a buy on NCC, one of the few stocks which is actually hitting new 52-week highs. And the whole road construction space is seeing a lot of momentum as well as the trend holding on. So NCC could be something which will continue on the trend. A big cup and handle breakout on monthly charts. A stop loss at 98 and a target price of 120.
All right, let's find out what exactly Kunal as well is picking out by way of his stock strategies. Kunal?
So a mix of buy and sell. The first one is a sell on Ramco Cement. It's a stock which actually has done pretty well over the last 1 week, but then the indicators have come back into an overbought territory. So would expect a mild correction from current levels. 717 as an immediate target for Ramco Cement. Stop loss at 754. And the second would be a buy on ITC. Have been bullish on the stock in the last couple of days. Even earlier, I expected the stock to come back towards a zone of 365, 370, which becomes a good zone to add as well as to buy. So now the stock is bouncing off from those levels. So expecting this rally to continue to levels of 400. Stop loss for this trade could be kept at 370.
All right, and let's revisit then the IT major Accenture talking about their annual revenue and profit forecasts, which have been lowered in the second quarter earnings report. They also went on to add that they will be cutting nearly 2.5% of the workforce, which is close to 19,000 jobs. Remember, they've lowered their revenue growth forecast to about 8 to 10%, and that could be seen as some sort of an indication that there are worries of lower IT spends as well going down the line. Let's listen into what else the management of Accenture had to say about their Q2 numbers.
New bookings were a record at $22.1 billion for the quarter, representing growth of 17% in local currency with an overall book-to-bill of 1.4. Consulting bookings were $10.7 billion with a book-to-bill of 1.3. Managed service bookings were also a record at $11.4 billion with a book-to-bill of 1.5. We were very pleased with the strength of our new bookings, which were broad-based, delivering a very strong book-to-bill across all of our geographic markets and across our services, with a book-to-bill of 1.5 in operations, 1.4 in technology, and 1.3 in strategy and consulting. Turning now to revenues. Revenues for the quarter were $15.8 billion, a 5% increase in U.S. dollars and 9% in local currency, and we're at the top end of our range, adjusting for a foreign exchange headwind of approximately 4% compared to the 5% provided last quarter.
We believe that the ongoing volatility and uncertainty in the macro environment is making it even clearer to clients that they need to change more, not less, and that 2 of the 5 key forces of change that we have identified for the next decade, the need for total enterprise reinvention and the ability to access, create, and unlock the potential of talent, are critical to succeed in the near, medium, and long term. We see 2 common themes. First, all strategies continue to lead to technology, particularly cloud, data, AI, and security. This is reflected in the latest market estimates, which are down slightly, but are still hovering around 5%. And second, companies remain focused on executing compressed transformations to achieve lower costs, stronger growth, more agility, and greater resilience faster.
Okay, let's see what we can derive from the Accenture commentary for Indian IT companies back home. We have with us Omkar Tangskale joining in on the show right now. Omkar, hi, morning. Great to have you on the show. Omkar, I guess what's been catching the headlines is that 19,000 job cut, but the underlying numbers are not that bad, nor is the commentary. Yes, there's a marginal cut in the upper end of the guidance, but the numbers look pretty robust.
Yes, definitely. Actually, to be very honest with you, I am very surprised with the positive results that they have come up with. Actually, you have seen the results and the guidance range that is into the consulting, the whatever the cautious steps that Accenture have taken or cautious steps that Accenture have mentioned is about consulting business. However, the managed services, which is largely comparable with Indian IT services, has actually shown a resilience in the business, and the demand drive has also seen continue to be stronger. So I am very I am cautiously optimistic about the Indian IT services, as because even the deal which came surprise with 11 odd billion dollars and 4 out of 22, out of which 11 odd is the managed services deal pipeline. So it just looks to be IT spending from the various parts of the world economies are continuing to be resilient, and the cloud business also they have guided for the double-digit growth going ahead, which is largely again comparable to Indian IT services. So I am actually a very positive. I am cautiously positive about the Indian IT part and surprised positively with the results.
Omkar, yes, as you highlighted, there will be double-digit growth in cloud and even the security business. But did the fact that they said that the deal conversion rate might slow down in certain verticals, did that come as a bit of a disappointment, or was that pretty much on expected lines? And were there any other, key commentary that would be taken as a disappointment or as a red flag or warning signal?
Yeah, I mean, one should take, if you can compare the kind of, slowdown or kind of recession we were expecting, nobody knows what will be the momentum or magnitude of it. But you can, consider it as a couple of quarters saga of next 2 to 3 quarters, or let's say 6 months for that, one can expect a delay for the newer projects or newer IT spends. But for the ongoing projects, you just cannot just cut off the automation part, because your business is depending on the system now. So I believe cautious steps to be taken ahead for the next couple of quarters. But long term, for the 9 months or yearly guidance, we can expect a positive news, and demand will likely to fetch again for the side. Coming on to the 19,000 job cuts, after the COVID levels, the demand got exponentially high. So that on the supply side, there was a massive constraint, and people started overhiring for the get the projects done. And so that's why it's going to be a plateaued up. One should see as when it's being more of a settling down or supply side constraint, and then going ahead it will likely to be continuing. So I am optimistic, and one should take out as the magnitude of this slowdown will not be a much. Yes, definitely there will be some uncertainties for the newer projects. One can face a delays or spend cuts completely for the next couple of quarters, but going ahead there will be a larger demand side.
Omkar, lastly, have to ask you, looking at Accenture commentary, now that you are upbeat about Indian IT, what's on the buy list?
Yeah, definitely. I am cautiously optimistic again for the Indian IT services, because they are also consistently, performing well, getting the ramp up on the newer projects quickly and started delivering, so that they does not face any deal cuts or this spending delays. But I believe one should see a optimistic view in a longer horizon. Yes, definitely uncertainties will likely to be there for the next couple of quarters, but it will definitely a positive sign for Indian IT services as well.
Okay.
Right, Omkar, we'll let you go on that note. Thanks so much for taking time out and making sense of the commentary coming in from Accenture. In the meantime, then, let's get in some stocks as well that are in the news and find out what exactly our chartists are betting on, and getting a take then from Chakri Lokpriya as to what he's betting on as his fundamental calls.
Kind of. So which means the Fed has actually increased rates. This 25 plus another 25 is already kind of reflected in the bond yields. Now, bond yields falling by about 140 basis points is important for the Indian banking sector, because that's very important in terms of how the cost of funds will work out. And so I think clearly as the credit growth is likely to slow down for the Indian banking sector as a result, and valuations are on its side. So I think from that perspective, I think IndusInd Bank, while looks okay, I think still I'll stay away from it. There are several other banks, including PSB banks, which are looking at that.
The big story forward this Friday morning, which is that amendments in the new finance bill, which means the huge indexation benefit which mutual fund investors, especially debt mutual fund investors, are enjoying, that is going to change. What are the implications of that? Is this something which is going to be changing the way how HNI investors, forget HNI investors, every investor is looking at debt schemes now? Feroze Azeez joins us, Deputy CEO with Anand Rathi Private Wealth. Feroze, good morning. Thank you for joining us. Feroze, I just realized a few days ago we actually live in the same building.
Yes, Nikunj. Good morning, sir.
I don't get to see you in the building, but it's good to see you at least on air.
Yeah, it's a privilege to be your neighbor.
Pleasure's mine. Okay, what does the new amendment in the finance bill mean for mutual fund investors?
Yes, Nikunj Sahab, it definitely means a lot. This amendment actually eliminates several categories outside the gamut of the long-term capital gain and the indexation, brings in the umbrella of Section 50AA on several classes. Apart from liquid fund, I think liquid fund most people don't buy from a 3-year perspective. The rest of it all gets impacted. This is the first time I've seen prospective application of a certain section like 50AA is going to be prospective 1st April onwards. I've never seen one scheme of a few fund having two different units being taxed differently. So it has a large impact. Today we have just about 60 lakh unique debt fund investors. That was supposed to be expanded to a larger universe, given the affinity towards debt for an Indian investor. But I think that's going to be definitely dented going forward.
For a debt investor, one huge draw was benefit of indexation, but it is also about asset class planning. So while indexation benefits are gone, but I'm sure debt schemes and debt investors would be cognizant that when you're investing in debt market, you're also taking a bet on an instrument. So that basic matrix does not change.
Yes, Nikunj, it doesn't change at all because taxation is the last criteria on the basis of which an asset or a vehicle should be chosen, point one. Point two, I personally think always taxation is never at an instrument level, it's at a file level. Let's assume in my house, there are 3 files, right? My wife, myself, and my child. There are 3 different files. Instruments by standalone can't actually tell you what tax you will end up paying. Because even if you have short-term capital gain, it's not interest income. So Section 73, which allows you to set off several things for 8 years, can be used. Second is in the new tax regime, for example, if I'm investing, I will invest my debt investments from my child's portfolio because he does not have an income. So up to 15 lakhs, the taxation is as little as 10% in the new tax regime. So I'm not too concerned for a retail investor. I work backwards for about a 10 crore portfolio as well. This will not materially change the merit of having that instrument in one's portfolio.
Brahmanyam also joins us now. Sunil, good morning. Thank you for joining us. Sunil, we are debating with Feroze that the amendment to the new finance bill and what impact that will have on the debt schemes and on the total assets under management for AMCs. Sunil.
So, first of all, I don't think, since we are providing a grandfathering, I just went through the proposed amendment, we're providing grandfathering. So, I actually expect that up to 31st March, you'll see a lot of money come into debt schemes, because once you put in before 31st March, you can hold it forever and claim indexation as long as you want. So, I see a big shift happening in the last week of March from other asset classes into debt mutual funds. That's number one. Second is post April 1, obviously debt mutual fund inflows, because HNIs were using this as a very tax efficient instrument compared to say bank deposits or other NCD investments. So now I see that definitely fresh inflows from HNIs into debt who do it on a taxation basis within the debt category, I think we'll see. Obviously, it's going to be hugely positive for bank deposits. The third aspect to this I see is that it's also going to retard the development of the debt capital markets for India. So as we are now going to a new capex cycle and corporates need more money, using debt capital markets, now if mutual funds are not going to get money from investors in debt category, how are they going to finance the capex cycle? So I think now they'll be more and more dependent on banks and term loans for financing their capex. So I think that this is a backward step from the overall capital market development, the debt capital market development in India, and compared to the advanced countries, we'll be way, way behind. The fourth thing is that I don't expect a switch from debt to equity. And I agree with Feroze there that asset allocation, is not based on taxation. It's based on goals, risk appetite, financial planning and all that. So, but there's a small category within the equity mutual funds which could benefit, which is called the equity savings funds. What equity savings funds do is they keep their debt only to 35%. The balance is put in arbitrage and in equities. Now, what it is, it gives debt-like return, but with equity taxation. So, at the margin, I would see some amount of flows from 1st April onwards increase in this specific hybrid category, where the risk is minimized, but at the same time, you're getting a tax benefit. Then, finally, I would say that this is not just about debt mutual funds. It's a whammy for international investing funds as well as gold.
Just to understand it a little bit better as well, Sunil, wanted to get in your take as to whether or not this is going to be advantages or a benefit now for FDs and pure equity schemes in your take?
Definitely a benefit for FDs. And within equity schemes, I just mentioned equity savings schemes are the ones which would stand to benefit because they keep their debt allocation to 35 and they keep their equity as a mix of arbitrage and pure equity. So that's one category benefit. Otherwise, overall, I don't think that it's more beneficial for bank deposits and other instruments rather than for equities, I would say. That's not really something that I expect.
One final word from Feroze. Feroze,
Yes.
let's understand if you have to weigh in, let's say, the advantage FD versus advantage fixed income. While we are discussing and debating that this entire new resolution, this amendment is going to be beneficial for fixed deposits, do you think totality, it may not actually happen that way?
Nikunj, I subscribe to what you just said. It will not change materially the love for FD or debt funds. I was reading one of the reports, it says that 1 crore 70 lakh crores is there in FDs. It is but apparent that in spite of having interest income, if FDs have had such a pull, that automatically implies that quite a few people are not worried about interest income because they don't fall in the income tax slabs of the highest rates. Will it impact the love for FDs of an HNI? I think they will be more keen for an FD, but I think most of India is not earning more than 15 lakhs, and especially a family of 4 is not. So I don't think a large flight of capital from debt funds to FDs is going to happen. FDs had the larger portion. It had almost 10 times the portion ex-liquid than debt funds, in spite of having a tax disadvantage of interest income, which does not get Section 73, you can't gift it to a major child. FDs are non-transferable. MF units are transferable. So you can, as a family, always manage the tax, and your CAs can very easily help you. Even if you have a 10 crore portfolio, I think the tax will not even change by 2-3 lakhs a year. Even if you are a 50-50 investor between equity and debt, I think people will try and combine these. Most people have 1/3 in equity anyway. So industry is going to create different funds, which is going to combine these two. Most investors have at least 35% in equity anyway. So the industry has to calibrate their product offering to make sure that this tax disadvantage doesn't remain. And arbitrage, I'm sure, will now form a part of most debt funds.
All right. Gentlemen, really appreciate your time. Thank you for joining us. So, the new amendment to the Finance Bill 2023 for a debt investor, the indexation benefits have gone. But like Sunil rightly pointed out, that this will be applicable from FY24 onwards, which means that you may actually get this window to enjoy the indexation benefit if you move back to debt schemes the next couple of days. So before March end, a lot of debt schemes are likely to get very large inflows. That's how I look at it. Sanjeev Bhasin joins us now. Let's connect with him. Let's talk stocks. Let's talk markets. Good morning, Bhasin Saab.
Good morning, Nikunj.
How are things? What are you telling your clients? Is it time to buy? Do you think worst of the price action, worst of the global sentiment, that's all behind us?
Yeah, good morning, Nikunj. I think we are fairly overdone on the weakness of the sentiment, and I have not seen such a weak sentiment since COVID. In fact, firstly, let me wish all your viewers and all of you a very, very happy Navratri and whatever way you celebrate. But we think that this could be a turning point. We are very sure that the front flow to China and other markets has played out. Three things in our benefit: low oil prices, the dollar becoming very weak, and bond yields. Now, the uncertainty on the rate and so on will continue, but the bond yields and the dollar are telling you that most of the fund action may be over with. And I think that India's underperformance now will start to see better realizations that quarterly results come. So definitely overweight India, and we think now this 16,800 is held out well. In the next 2 days, I think we will take out 17,200, and I will be very, very surprised at the expiry we see, because there is considerable amount of short position on the market, which can see a lot of covering and buying on value buying in the next 3 days.
Give us an example.
Hello?
No, I'm saying, can you share an example with us when you say that you see considerable amount of buying as it was emerged in the market?
Yeah, so look at the PSU pack. I mean, everyone was chasing State Bank at 600. At 510, I think this is a steal. Same is the case with another PSU bank like PNB or a Can Bank. All will report record profits. Yield softening is a plus for them. And plus, look at the macro environment. They are all saying, if I could hear Mr. Dinesh Kare, he said no impact of growth. In fact, the rural markets have started to see very, very strong growth. And I think banks are a proxy to that. Look at a stock like LTIM, the Mindtree L&T investment. I think their guidance is extremely positive. So, and if IT is going to play a catch up, then LTIM or an HCL Tech can be outperformers. Look at stocks like JSW Steel, which I think can be a very, very big outperformer given that coke prices have softened and a weak dollar means China demand will give them a real impetus. Look at stocks like Escorts, where again Kubota is now signaling that they are going to get more market share from Mahindra. And I think that this whole dialogue on drought and all is overdone. I think Escorts will rule the roost. If you are a long-term investor at 13 times, you're getting an MNC. And last but not least, Godrej Consumer Product. I think that is shining its way through the glory. So these 5-7 stocks are looking outperformers. On top of that, I think the Nifty itself is giving you a very, very good entry point.
Okay, that's the view, Sanjeev. Meantime, Naresh, I wanted to get in your take as well on some individual stocks in today's trading session, and just going by what we saw play out yesterday among the large caps, you did have a lot of those banks come under pressure. SBI, Kotak, IndusInd Bank, for instance, HDFC Bank as well. If you had to just handpick your top 3 banks, PSUs, private banks, mid, small caps, what would they be?
So, in the large caps, I would continue to stick with Axis Bank and ICICI Bank. Those two have created a retest move wherein they retested the last major breakout points and now are starting to make a comeback. And a good enough correction has taken place. So 950, 970 Axis has come down to 810 to 850 band. ICICI Bank similarly has made a move from 950 down to 830 to 850 band. Now, a retest of the last major breakout is done. These two could continue to lead on. In the PSU banks, it is SBI. The stock has corrected. It is back to that 500 and 520 mark, which is where the last rally started from, and corrected from 600 odd levels. And second would be going with Canara Bank in the PSU basket, which is again a stock which has shown a lot of relative resilience over the last 1 year. So that has also corrected from 340 to 270 to 80 band. And in the mid cap and small cap, it continues to be IDFC First Bank and Federal Bank, which continue to show longer term charts to be positive.
Okay, stay on with us. Let's take a look at the newsmakers. HAL's OFS, that was opened yesterday for non-retail investors. It was subscribed over 4 times on day 1, and the OFS will open for retail investors today. Let's get in Sharath. He joins in with all those details. Sharath.
Well, yes, important update coming for HAL's OFS, and of course on the end of day 1, the overall subscription stood at 4.51 times, and this is coming in for the non-retail investors. Today, with the issue will be actually opening for the retail investors, and the company has exercised its right for the oversubscription. Now going ahead, the company will be actually going for an OFS of 3.5% stake with a floor price of 2,450 rupees. Now stock itself, if you look, yesterday the stock did fall by almost 5% as the OFS had opened, and if you see over the last 1 year itself, the stock had a magnificent run with almost 78% gains. Now do remember that the stock is in FNO band today. Apart from this, what's the post OFS impact? That is something which we'll be watching out for, and this also includes that the stake sale is expected to increase the free float in the market, which includes the public shareholding going above the 25% mark. Apart from this, the important thing is the adjustments in the MSCI would be there, with an inclusion expected with a cut-off price coming down to 2,150 rupees from 2,650. Now because of this, it's expected that the brokerages are expecting that the inflows are expected to increase to the tune of $195 million from the $155 million mark.
All right, thanks very much, Sharad. That's HAL in the spotlight. Sanjeev, meantime, wanted to get in your view on some recent brokerage notes that have come out. PB Fintech is actually on Morgan Stanley's radar. They've upped the target price. It's 810. They're seeing further scope of re-rating, saying that adjusted EBITDA is going to be the key metric. Do you like PB Fintech? Do you like any other stocks within New Age Tech?
Yeah, good morning. So, Awan, some of these baskets are looking good, particularly Paytm and Zomato, and like you said, PB Fintech, but your duration has to be longer. However, in the near term, when I'm getting SBI at one-time price to book, and in this fear psychosis, all banks giving you an entry point, I would rather put my money in the near term in some of the banks. And I think that they could yield faster. But like you said, some of these fintech companies, if you can allocate 2-3% of your capital and save put for the next 2 years, then you will definitely see some return which is greater than the market. The issues are that at this time, there are enough bargains available in the market on fully transparent earnings and so on, and you would rather stay with them for the short term.
So if you could highlight some of the names, I know you're being selective. I know you're saying that it is better to put your money in other avenues, but if you could highlight which ones you like.
So Aman, I'll give you 6-7 names. LTIM is my top pick, that is L&T Mindtree. Then I have SBI, Canback and PNB, which Nuresh also suggested. These are very good stocks to buy. Escorts, like I told you, Kubota's gaining market share 13 times 1 year forward for an MNC. JSW Steel is another very, very big pick, and Kotak Bank in the large cap. But my dark horse play, last time I was on your show at 270, 280, I told you SW Solar. SW Solar is the largest EPC player in the world. It is the sole agent for providing EPC and MEP for any solar panel and PVs. And Reliance Energy now has a 40% stake. I just had a conversation some time back with the management. They had an order book of 800 crore till last year. This year they are executing 4,000 crore. And by next year, it can even touch 10,000 crore. They have a margin of 11 to 12%. So you can imagine the bandwidth this stock has to create wealth. It is just an 18 crore equity. Reliance Energy owns more than 40%. And if you do your homework and sit still for 1 year, I can guarantee you this year it will be a doubler.
Sanjeev, hold on to that thought. I have many more questions about Sterling and Wilson, which I'll just come to in just a second. But here's an ET Now exclusive. Sources are telling your channel that TPG Global plans to exit Campus Activewear by selling its entire 7.6% stake via a block today. Pankaj is here with more details.
Absolutely. As you are saying that TPG, which is one of the first investors in second round of investors, in Campus Activewear, after 1.5 years of listing, has decided that it's going to sell its stake. Yesterday, it opened a block for investors where they could bid. It's a small block, 800 crores, about $100 million is what the total size is, but it's a big one in terms of the total percentage, about 8%. JM is the sole banker to the deal. What I'm also picking up is that 345 is the floor price to this particular offer, which means a good 6-7% discount to the current market price is what they are actually offering. TPG was the second round of investor, and now they have decided to do this, to sell out of this particular Campus Activewear.
Right. Sanjeev, to the point that you were making on Sterling and Wilson, the stock has already appreciated 78% in the last 52 weeks. At 310 thereabouts, can one make a fresh entry at this current juncture?
Yeah, good morning, Aisha. You're seeing from the lows. The issue came in 2019 at 750 rupees. So it's far cry from just its issue price. And now it's not Shapurji Palonji, it is Reliance Energy. They've cleansed the balance sheet and they've said there are no domestic, there are no in-house orders in this 4,000 crore. It's all external. Now look at Reliance's foray into PVs and so on, and what they've assured in state government meetings, and that's the future. So even if they get 40% more orders from their parent company, you can imagine the book. But the problem is there are fixed costs of about 360 to 400 crores, which will be, which are there as a recurring cost, just as in any industry you have. If they can order book, which they are doubling in the next 2 years or 3 years, the future is solar panels, and that energy as a whole is going to be, and you need someone to do the EPC or the MEP, that is the maintenance, electrical, plumbing, and the EPC business. For that, there is no other company in the world better than SW Solar. I am looking for a target at least of its issue price of 750, and then we'll take it from there. I know it's bold to show that at this time, but we'll see how it plays out over the next, over this year.
50, that's almost double or more than that actually, but that was the issue price. The stock currently at 310. Kunal, not as actively tracked, but I don't know if you're looking at the charts of Sterling.
Oh, don't track the stock as such, Aisha, so won't be able to offer any comment.
Sure. Okay, let's look at some of the other buzzers from yesterday. And Balrampur Chini surely was one such case in point. 375 on the stock price right now, 3% higher. Sanjeev, still got conviction on the sugar story?
Well, yes and no. They keep giving you the entry and exit points. The stocks have been multi-baggers, and we know that in the soft commodities, sugar has been in a very sweet spot. Also, given the outlook on the weather and some of the things, I think the prices have gone up. So Balrampur Chiri, DCM Shriram and EID Parry on any decline would be buys. But look for slightly longer term. Don't play the weather patterns because our seasonality, will see quarterly performance being affected by that.
Okay. Meantime, yesterday you had something like a JK Tire which shot up. Spark as well saw a nice double-digit gain, and BEML featured on the radar. Naresh, let's get in a quick view on the charts of these smart movers.
So, say Spark has made a single day move. It's been in a downtrend for quite some time. A single day move, and the spike actually fades off for the stock. In between, also the stock had spiked from 200 to 225, and then we ended up at 160, 65. We've spiked up to 180 today, but the stock has gone nowhere for the last almost 3 to 5 years now. The stock used to be 160 back in 2020, 2014 also. So technically, very tough to take a call here. The trend continues to remain weak. Not trying to play the bounce back here just because of a one-day move.
Sanjeev, what's your outlook on the entire healthcare space? Do you believe that one really needs to be very selective, largely due to the commanding valuations, US FDA concerns that pop up now and then, or would you have a sort of a blanket positive stance?
Yeah, good point, Avan. See, they've underperformed for a long time after the COVID abated and so on. But if you wanted to pick, particular stocks in your portfolio, then I think stick with the large caps. Dr. Reddy and Sun are two large picks. Lupin has always flattered to deceive, but now the management seems very keen on increasing market share. Their generic pricing are improving, and I think they've been through a lot of the problems. So at 700, I think that gives you a very good risk reward. But the whole essence is, Avan, do you want to be in defensives or do you want to be in active trades? I can assure you from here, the Indian markets are looking very, very upbeat for some more, time-bound correction. But next week onwards, I would expect the outperformers to be banks, metals, IT, and auto, because that is where the consumption basket lies. We are in the Norata periods, and you know that March onwards, the festive spending and the buying in the new year will be very, very huge. We've already seen that softening of commodity prices are going to be anti-inflationary, and that could see even the central bank like RBI actually take a pause. So I'm very bullish on the entire high beta space like banks, auto, IT, and metals.
That's quite interesting and leaves us with a plethora of options to buy into right now. HAL, that's the other stock that I just want to, pick up in trade. While it's surely gained about 78% since last year, the stock fell a good 5% yesterday. Now, the OFS update has come in. The OFS has got subscribed on the first day. That's the non-retail portion at about 4.5 times. The OFS is going to open to retail investors today. Sanjeev, subscribe or not?
100%. I mean, you can't have a better play than HAL and BEL and a Bharat Dynamics, and defense is here to stay. As a disclosure, we've been long on this stock all the way from 1250, 1300. It is a doubler, but we still think there is miles to go, given the balance sheet, given the order inflow, and now given the outlook that India is ready to do something for people like, countries like Israel and so on. And I think defense is a must-have. Only the valuations were a little discomfort. Now, I think this overhang of the OFS will be over, and sooner you'd see at least a 20% gain even from these prices.
Kunal, are the charts reading the same? A 20% gain from the current levels for HAL?
Well, I think it's come back into a good buying zone. I would say that from earlier levels of 2,800, 850, almost a week and a half out back, it's come back towards a good neutral territory as well as a good support zone. 200 DMA is also very, very close by for the stock price. We've seen how most of the defense names have taken a pause or a pit stop at this 200-day moving average for few trading sessions or few weeks, as the case may be, and then these stocks have seen a good uptick. So I think in that regards, possibly the stock may come back towards a good support point, which is just around that 2,400 mark.
Okay, meantime, you also have a fresh brokerage note on Hindalco this morning from JP Morgan. They maintained an overweight rating, a 490 rupee target price, saying that the near-term earnings should improve, though they've cut the FY24-25 EPS by 8 to 10%, building in lower LME. Hindalco is the stock that I'm flagging off. JP Morgan also saying that they expect capex to be aligned with the cash flow. Sanjeev, where do you stand when it comes to the metals basket?
Very bullish. Avan, the last time the yields went to 3.8, you hit 115 on the dollar. This time the dollar is on the verge of breaking 100 levels. And if it comes to 98, Hindalco will be flying to 500. So also coke prices have softened a lot. So both the steel basket, that is Tata Steel and JSW and Hindalco. Also, you can add a sale and a Jindal. So if you buy that whole basket or buy a fund which has metals over there, metals are going to rule the roost at least in the next 3 months. And I think the valuations are now very, very reasonable given the earnings opportunity and the China reopening. That is going to be the real kicker for metals and banks and that whole proxy which I told you. But Hindalco is a must-have around these prices. Along with that, include a JSW Steel, which I think can be a huge outperformer.
Okay. Meanwhile, Naresh, within the cement space, what would be your strategy?
So out here, Ultratech Cement has been on radar because technically the stock has been shaping up for a breakout above that 7400, 7500 mark. If you look at the last 4 months, there have been 3 tops around that 73 to 7500 zone. Every time it has been a little higher. If this breaks out, this could go towards 8000 levels. And the stock has been showing relative resilience. So Ultratech Cement is one, and second is Ambuja Cements. The stock has made a strong base around 330. The last bottom at 350. So it's starting to make higher bottoms. It's forming a triangle out here. Once it crosses 385, that would be a short-term breakout. And even at current levels, that is a stock one could be looking to buy at dips with a stop loss at 350. So would go with Ultratech and Ambuja Cements.
Look at some of the movers for the week gone by. So pull up the 7-day chart or the 1-week chart of some of these stocks. Adani Green has seen a smart gain of about 26% or so. But then there's been something like an Anupam Rasayan. That stock as well has gained pretty smartly for the week gone by. Aarti Drugs, another smart mover, currently at about 373 rupees. The week has been pretty healthy for this one. You've also had an Angel one, which has seen a double-digit gain. Along with that, a JBM Auto. On the flip side, though, Sobha has had it a bit rough, nearly 17% being shaved off for this week. There's been an IRB Infra as well. It's been a bit choppy, down nearly 8%. HAL, we just flagged off that stock as a newsmaker, and for the week gone by, after all the give and take, it's lost out about 8% or so. Kunal, let's get in a take on the charts then. Something like an Angel one, maybe Anupam Rasayan, if you track that one, a JBM Auto, basis the kind of run-up that we've seen this week.
So Angel one is interesting because the stock has formed a classical double bottom on the recent charts. So I think the month of February and March, just the first couple of days of the month of March, the stock formed a low which was almost at the exact 1000 odd levels, managed to rise up to 1120, 1140. Second retest was just about a few trading sessions back at the 1000 mark, and then today the stock is back again above that 1120 mark, which means it's a classical double bottom at play for Angel 1, and this generally indicates that a major bottom could be at place for the stock. So 1000 could be a major support, and for traders who are looking out to build long positions can keep that support or a stop loss and look out for building long positions. Even if the stock goes into a mean retracement or a mean reversion towards its 200 DMA, we could expect 1300, 1350, which is the 200-day moving average, as a near-term target for Angel 1.
All right. Well, the Sanjeev Basin Saab, brokerages, is it a good time to buy them? I read a report that retail brokerages and retail activity is down 50%. Kunal Bhai is saying buy Angel 1. What is the reality at IFL?
Well, yes, there is sluggishness. A large part of the portion has diverted to derivatives and options, and people are a little bit on the the low volume side. But I think it's a passing storm. As a disclosure, I cannot name our stock. I have options, but I am very bullish on the industry as a whole because the intermediary phase of more and more funds or the route of brokerages are getting even more, and cross-selling is picking up very, very dynamically. So I would be very, very bullish on this industry if you have a 2-3 year view. In the near term, yes, like you said, there could be operational costs which can eat into margins.
ICICI Securities, Engine 1, when they were the haloed stocks. Trust me, they were the haloed stocks of 2021. Number of demat accounts were opening. The PMS activity was opening higher. IPOs were flying high. So, they had this huge patch of extraordinary return and extraordinary growth. I want to go back to your stock ideas, Basin Saab. You like HCL Tech, which is cheap, but it is growing at a run rate which is higher than the industry average. but you also like LTTS, right? Apart from Tech Mahindra, you also like LTTS, right?
LTIM.
LTIM, sorry.
LTIM, yes.
Yeah.
The Mindtree pedigree and the type of businesses and the merger are huge. I think LTIM is a flyer from here. So LTIM, HCL Tech, Tech Mahindra. Tech Mahindra, if you recall, Nikunj, in my December when I had the show with you, I very, very vehemently suggested that closer to 1020. Then it's 2 to 1120 on the change of management. And I think that change of guard will play out well. But LTIM, HCL Tech and Tech Mahindra, these three are going to be outperformers.
Okay. These are a couple of stocks which are in focus. Well, Vedanta, given all the news flow around it and the management denial coming in yesterday that they're not looking at a stake sale, the stock didn't see any much of a recovery play by yesterday as well. Now they've got a board meeting coming up next week on 28th, which is Tuesday, to consider the fifth interim dividend. So let's see which way this stock actually heads from there. BEL, we were just chatting with Sanjeev about HAL, and he says that the OFS, given that the retail book is going to open today, it's a thumping subscribe. BEL as well is a stock that he likes, and it's backed 2 contracts from the Ministry of Defence worth about 3,800 crore rupees. So sizable order coming, their way. That's BEL in trade for you. Kunal, just very quickly on the charts for just a HAL and BEL. If you had to pick one to go long on, which one would it be?
So off late, I think BEL has shown a lot more consistency around this 1992 mark. That's a strong support zone for BEL. HAL is still yet to tap back into its strong support zone at this 2,400 mark. So maybe the stock corrects by another 4% from yesterday's closing, then it becomes attractive. But I think BEL at current levels, price-wise, looks at a very attractive zone.
Okay. Pre-open rates. In the morning when we walked up to trade, when we walked into the office, SGX was down, but there is a mild recovery there. Now, what is important here is that the dollar index is now below 103. That is something which will have long-term and medium-term implications. The dollar goes down, emerging markets go higher. This time, dollar is going down and commodity prices are not going higher, and that is excellent news, because if historically dollar weakness has always coincided with strength in commodity. But since you're coming off the base on inflation, this time the dollar strength may actually translate into more strength for emerging market equities. So we can argue about the attractiveness and the entry points about a market like India. But if you stretch the timeline, start counting in terms of quarters and years, then even today also, if you invest for next 3 to 5 years, I'm absolutely clear that markets will create wealth for you. What happens in the short term is a function of technical sentiment, global pressure, macro. You put all that factors together, obviously the near term will look slightly more volatile and uncertain. There is intense volatility in global markets, which will surely have impact on Indian markets, per se. Basin, why do you like PSU banks? I mean, PSU banks are cheap, credit growth is strong, but they're also struggling. They're struggling because they are not getting deposits. They're struggling because they're losing talent. They're struggling because they are not the first port of call in terms of in terms of technology and customer experience.
Well, you've seen how they manage their market share. CASA ratios are strong, and I think they're from the management which I've met, PNB and CanBank, they said we are sitting on cash. We don't need. Look at the type of credit growth. Plus, they've taken a large part of the market share in the credit side on the retail side. They are also doing extremely well on the MSME side. So, it's a whole basket that these stocks were underperformers for 5 years. Now they've been through this consolidation. But I think that given that now technology has taken away costs, pension funds are seeing less people on the floor. And I think that their reach, you go to any city or town, I travel pan-India, you'll be amazed at the branch network and the facilities now. I think there is a new realm of how people have changed. Look at how Bank of Baroda and the others have, started to change into the timeline of private banks. So no two ways. If you are looking for wealth creation, PSU banks are going to continue to do that, at least in the next 2 years, till we see some wave of NPA cycles and so on, which will obviously be there in a hindsight. But right now, on a valuation basis, the book, the CASAs, they are all giving you very good entry points.
163 for Bank of Baroda. Nuresh, which is the strongest PSU bank? They're still up 50%. They may be off 20% from the recent high, but they're still up 50-60% in last 1 year. Sanjeev साहब ऊपर क्या देख रहे हो? I saw you staring at the screen. TV ऊपर क्या देख रहे हो?
Looking at you.
आपको देख रहा हूँ, आपको फोटो देख रहा हूँ ना।
अरे सर सामने देखो, मैं दिख जाऊंगा, ऊपर नहीं हूँ, मैं नीचे ही हूँ।
अरे सामने आपने ईटी नाव लगाया है, ना आयशा दिख रही है, ना आवाज दिख रही है, और हमारा तो वर्थ है, तो अच्छी सूरत दिख जाए तो शेयर बाजार भी अच्छा चल जाए।
चलिए, Nuresh.
So all the PSU banks have now corrected a good 15-20% from the top and have started making a base. So all the charts look pretty similar. So SBI has corrected from 600 to 510, a Bank of Baroda from 195, 200 to 160, a Canara Bank from 340 to 280. So all are making a base and are very critically placed at the support level. So from here, there should be a bounce, or if this breaks down, we would get into a little more correction. But as of now, we are seeing that supports hold on. So till the time we are above 500, SBI still looks the most risk reward buy. Same is the case with Bank of Baroda. Till it holds above 150, 155, still looks interesting. So all the three as a basket look pretty promising.
Okay, Sanjeev, great to have you on the show and hope you have a good trading day, pretty face or not. Let's just revisit what the market rates are settling in at in the pre-open rates. And it seems like it's going to be once again, one of those tempered days. 17,035 thereabouts is where the Nifty is. A lot of stocks which are going to be active, but that we will address in just a second. First, let's get you some mid-cap trading ideas. Kunal, what's on your list?
So Naveen Fluorine is one of the stocks which looks attractive on the charts, trading above the 200 moving average, forming a bullish flag pattern on the daily time frame charts, trading above that breakout point of this bullish flag pattern around the 40 to 50 mark. So would suggest a buy with 4,400 as a target, stop loss at 4150.
Right. Naresh, what about your ideas?
So that would be a buy on KEC International. The stock has been holding on about the 450 mark for the last 4 months. A base has been made. Stock is shaping up for a longer term breakout. In the near term, a short term breakout if it can sustain above 490. Yesterday was a little bit of a price and volume jump. So preempting it here, a stop loss at 460 and a target price of 550.
Right. Okay, let's tell you what else is happening outside the world of markets. And Rahul Gandhi was sentenced to 2 years in prison over a criminal defamation case, convicted by the Gujarat court for misusing the Prime Minister's surname Modi in an election rally back in 2019. Now, Gandhi remains out of jail on bail for 30 days, allowing him to appeal the decision. Also, quick look at the COVID situation in the country, and India has witnessed a record surge in cases. The active caseload now stands well over 7,000 cases. In a high-level meeting, Prime Minister Modi directed officials to enhance genome sequencing of the virus to track newer variants. Also urged people to follow respiratory hygiene and COVID-19 appropriate behavior. And reigning world champion Nikunj cruises into Women's World Boxing Champion finals. In fact, after delivering a commanding 5-0 win over Colombia's Ingrid Valencia in the 50 kg category semi-finals. Meanwhile, two-time bronze medalist Lovina managed to beat China's Li Qian by about a 4-1 margin, booking her maiden appearance into the finals. Also, shares of Jack Dorsey-led payments company Block plunged as much as 15% after Hindenburg held short positions in the company, alleging that the company overstated its user accounts and understated its customer acquisition costs. In fact, in its latest report, Hindenburg describes Block's internal systems as a wild, wild west approach to compliance. Also, Russian officials, Dmitry Medvedev has warned that if Russian President Vladimir Putin gets arrested overseas, it would mean a declaration of war against Russia. The assertion by the Russian diplomat comes weeks after the International Criminal Court issued an arrest warrant against the Russian president over the alleged war crimes he committed in the midst of the ongoing Russia-Ukraine war. And nationwide protests have entered the 9th day now in France. Police has fired tear gas and fought with violent black-clad anarchists as hundreds of thousands of protesters have marched against President Macron's plan to raise the pension age. Though the demonstrations in central Paris was generally peaceful, groups of black bloc anarchists smashed store windows, demolished street furniture, and even burnt down a couple of the public buildings. Okay, in the meantime, let's get back to markets. While the pre-open rates are settling in just about flat right now, Chris Wood of Jefferies says in his latest Greed and Fear report that the domestic demand story remains pretty much intact, which is cementing the belief in equity markets. Pankaj is here with all the details from that note.
Well, thanks for that. Christopher Woods of Jefferies' Greed and Fear note, which comes in on every Thursday night or Friday morning India time, has written about India this time, and they are saying very interesting fact that India-China valuation differential has reverted to the mean. Since October 2022, markets did pretty well in China. They are up about 50-60%, and there has been a huge outperformance. But now the valuation differentiation, one on MSCI India coming down, and second, China its share going up, has fallen quite significantly. Now for India, it continues to be that it's a sort of a domestic story. It's a sort of a story which is driven by systematic investment plans. It's a plan which continues to show resistance despite the sort of move that you have seen across the board as far as FII selling is concerned. They continue to maintain that capex and residential are two things to watch out for. That's the main story that they are looking for, and that is something which essentially continues to make them believe that India is now one of the best placed markets within the Asian equity markets and the overall emerging market basket. So positivity continues for India, led by domestic demand. It will be capex and residential that they believe would do well.
Okay, let's get you some of the index calls and tell you what is the consensus, if at all or not, on the Nifty firstly. And yes, pretty much a consensus. It's a hold across the board from Kush Bora, from Naresh Mirani, as well as Kunal Bothra. And my guess is it should be a consensus even when it comes to the Nifty Bank. It would be no different, although most of our experts have maintained that it's a more stock-specific approach that you need to take in this market than an index call. But yes, it's a consensus hold there as well.
Well, there is a important tweet or quote from Jeff Goodluck. He's a master bond investor. And there you go. Jeffrey Goodluck, investor. I'll predict that Federal Reserve will be cutting rates substantially soon. Okay. I'm wrong about 30% of the time. So factor that into any decision making, which means he's indirectly saying that he's long short-term bonds. Because if interest rates come down, more than the long duration, short-term bonds will actually do well. And there is logic and there is absolute merit in perhaps endorsing what he's saying, because the bond yields are at 3.5%. Global commodity prices have come down. Dollar is weakening significantly. And you've got US elections in 2024. And the last thing any political party would want, at least the current ruling party would want, is that you want to approach a new election cycle with high inflation. And the only reason to bring inflation down is perhaps to keep interest rates under control. So that's his view on where interest rates actually headed. In the pre-open session, the first rates are indicating that we could be in for a decent start. And if you're in for a flat start, Kunal, will you go and buy the Nifty?
Not really.
Why?
So I think now it makes sense to buy the index only on a breakout, which is at 17,200 mark, or at a point when the index comes, say, closer to that 16,800 levels, where the risk reward could be 1:4, 1:5 for the index trader. In between, at that middle point of this 400-point zone, the risk reward is neither in your favor, neither the trend is in any kind of a clarity. So it doesn't make sense to initiate any kind of a buy.
Naresh?
Similar view, say you have a position, you hold on, keep a stop loss at 16,800. Can start, say, adding more positions only when we start crossing 17,200. It's been the last few days we've just stuck in this band, and we are, although it's a 400-point band only, but we are right in the middle of it as well. So waiting for, say, further price action to take a new stance.
Okay, just getting set for the market open rates. Look at the currency, and that too has started off just absolutely quiet around that 82.23 odd level in trade. A lot of stocks which are going to be in focus. Top, of course, is going to be IT companies after what Accenture delivered, and that, by the way, was a robust commentary, although the upper end of the guidance has been trimmed a little bit. And yes, the headline catcher has been those 19,000 job cuts, but the numbers are robust. In fact, I want to see what IT Pack is doing right now in trade. in the pre-open rates itself and what the IT stocks are up to. Let's see what TCS, Infosys, HCL Technologies, LTI, LTTS are currently doing. Those stocks will just come up for you on your screens next. HAL, of course, is the other one as well. The non-retail portion has been subscribed about 4.5 times the base price. And of course, today is when you have the retail portion as well opening up. So that's HAL in trade. Finally recovered lost ground as opposed to what it was at in yesterday's session. But yes, Nikunj, I guess we get back to that same question. The event risk is over, but volatility is still here.
Yeah, and that's, I guess, not the unnerving part, but that really is the strange part, because a lot of action was centered around the Fed commentary. And frankly, in my book, you've come on the right side of the Fed commentary. There's nothing very destructive in the Fed commentary. If at all, they've gone on to endorse that they will take care of the depositors. They will ensure that they will use all tools available to them to stabilize the US banking system per se, or US financial system per se. So while the risk of event is behind us, there is no real excitement in where things are moving, at least in the near term. FI selling has reduced substantially than what it was, let's say, same time last week or earlier this week. So last couple of days also, at least on that front, the news actually is not bad. So are we in for a rebound, or it's going to be a casual day of trade with markets not going anywhere? There are, of course, pockets of heightened activity, PSU banks, some growth stocks, that's about it, but nothing beyond that, I guess. First rates, and it's a flat start. Can you imagine? I mean, a 17,000 index has a 2-point change, neither here, neither there. The small cap index, 0.5%, not even 0.5%. Small cap index is now up 6 points. The mid cap index not going anywhere. I mean, this is almost like saying that there is just no price action. Nobody's just interested. The premium has collapsed, volumes are dry, retail activity has got completely subdued. The breadth of the market is not looking meaningfully better, but the breadth of the market is looking slightly better. Accenture numbers. First thing, let's capture that for you, large cap ID. TCS, Infosys, Wipro and HCL Tech. Wipro, BFSI play, up. TCS, BFSI play, up. HCL Tech, Wipro is not a typical BFSI play, but Wipro has got their own set of challenges. HCL Tech, BFSI plus infrastructure management service, both of them put together, the reaction I think is solid. Tech Mahindra is not a BFSI play like Accenture, so it is rising the least. So tech is off to a good start, tech is off to a cozy start. Fintech now and consumer tech. Zomato, Paytm, Policy Bazaar. I think there's a big upgrade on Policy Bazaar by one of the foreign offices. And there you go, Paytm, Fintech, Zomato. None of the stocks are giving IT stocks a company. So take idea of the equation, Aisha, nothing in the market again.
Yeah, IT really is the one which is hogging all the limelight this morning. So that is looking good. Let's see what else is, if at all there is anything. HAL, is it seeing any rebound after yesterday's breakdown when the OFS got announced? That stock has made a move of about 1.5%, although it fell a much larger quantum yesterday. It was down about almost 5.5% or so. BEL as well, they've bagged 2 contracts from the Ministry of Defence worth about 3,800 crore rupees. So that is another stock which is in focus. Lupin, they've got a tentative approval from the US FDA for one of the acid tablets. So let's just see what that stock as well is up to. Vedanta board meeting on March 28th for a 5th interim dividend. Campus Activewear, we just reported to you that TPG, I beg your pardon, is looking to sell that 7.6% stake via block deal. The floor price has been set at 345 rupees per share. That, of course, is what sources are indicating to us. Campus is down 5.6% as we speak right now. What are mutual fund companies doing? The few ones listed over a 3-year debt mutual funds won't get indexation benefit. That's the finance bill amendment proposal, and that's the space, Nikunj, which is really bleeding this morning.
Yeah, I mean, as it is, things were tough for them, and now things will get tougher. So the large part of the institutional debt holding and HNI investors who've always decided to invest in the debt schemes because of the indexation tax advantage, that arbitrage is over now. Compulsions and asset allocation models will not change, because when you are doing asset allocation calls, at least in the debt market, tax considerations are important. With equity, that consideration may not be there because they're different asset class. But for debt investors, I think at least for fixed income investors, that's very large. Now, why Motilal Oswal has not fallen? Well, simple. They don't have a very debt portfolio. Anand Rathi Securities, well, if money moves back to equities, they'll get more commission. UTI MC, large debt exposure. Birla MC, large debt exposure. HDFC MC, very large debt exposure. So all that is moving in a classic manner, so to speak now.
Yeah, it really is. HDFC MC is taking a whack, 4% lower for this one as we speak right now. But Kunal, given that nothing's happening on the index once again, what are the first trades you're executing?
So that'll be ITC. I think that stock still looks quite strong, more formidable at the 375 to 80 zone. So that's a stock which I look to buy. My expectation is that the stock would probably come back towards the previous highs of 394 to 400 over the near term.
Naresh, what about the first trades that you're punching in?
Still playing defensive, trying a bounce in NTPC at 174, 175.